investing, but I only have like $500. What should I buy? All of them, son. All of them. All of what? The stocks. I've only saved like $500. One share of Chipotle is already $2,000. Right. Or you could buy one of these and you'll have all the stocks in the stock market for less than $500. That's right, folks. Today, we're talking about how $500 could land you the entire stock market. But more importantly, we're going over not one, not two, but 3 stocks that I'm holding on to for life. In fact, this 3-stock portfolio we're going over today is gonna get you on the path to success with a much higher probability of making you a millionaire than any of those strategies that you see online. But bruh, the professionals on Wall Street and my crypto bros? Professionals on Wall Street fail to consistently beat the market year over year. And as for your crypto bros, well, that's a conversation for another day. So then, if the pros on Wall Street getting paid millions can't do it, you and I do not stand a chance. And a disclaimer, I am not a financial advisor. This is not financial advice. I am a guy on the internet who likes to talk about my stock portfolio, and I'm just trying to teach you what I've learned. In any action you want to take, I highly recommend you consult a financial advisor or planner if you have additional questions. That being said, this video is going to break down into 2 parts. The first part, what's the actual philosophy of getting to this 3-stock portfolio? The second part, we'll talk about those 3 stocks. And be sure to stick around to the end. I'll give you a bonus stock of how you could even condense these 3 stocks into a 2-stock portfolio. If that sounds like a plan, y'all know what to do. Pop a squat, tap the thumb icon. Any questions, comments, obviously drop them down below. Let's go ahead and get started. As we start going over the 3 core fundamentals of my investment philosophy, I'm gonna give you 2 tips. Tip number 1. Invest early. Compound interest is your friend. Do not feel like you need to wait for the right time to invest when you're getting the new job, when you're making more money. No, the right time is today. The best time was yesterday. Einstein called it himself. Compound interest is the 8th wonder of the world. Let's say you started investing at 18, $400 a month into a low-cost index fund with 8% returns. After about 48 years, when you're ready to retire, you've got over $2 million. Let's say instead though, instead of starting at 18, you waited until you were 28. All right, you're still in your late 20s, not bad, right? Well, your investment returns would be cut in half to just $1 million. Luckily, the correction is simple. Just jump in the market. The second tip I have for you is be consistent. Do not panic. When things are up, that's great. When things are down, that's great. You are going to be consistent because the biggest mistake I see folks doing is, oh my God, the market is going up, I'm gonna buy in. Oh my God, the market's down, I'm gonna sell out. That's the exact wrong thing to do. And studies have shown time and time again, folks who get out of the market are not as likely to jump back in. Let's think about the crash in 2020. A lot of people sold out thinking the world's ending. Guess what? Ripping bull market within 6 months of that dip. So be consistent over time. How I personally rationalize it is, if there's a sale at Apple, if there's a sale at the grocery store, I'm jumping in, I'm buying all that stuff. Well, why don't we think about the same when it comes to investments? If that thing is red, that's a sale. Now, the 3 parts of my investment philosophy. This is borrowed entirely from the Bogleheads. It's a community of folks who subscribe to the philosophy from Jack Bogle, who is the founder of Vanguard. He famously created the modern day index fund, and I'm gonna go ahead and explain to you exactly what that means. So the first part of the investment philosophy, expenses. Cut them. They're doing nothing but killing your returns. Let's take a look at an example where we're again going to invest $400 a month over 40 years at, let's say, an average return of 8% a year. In the first example, we're gonna look at a situation where you're going to get charged a 2% fee of your assets under management. This next example is looking at a 0.03% fee. The difference in return over 40 years, folks, is $500,000. As in, the lower fee option returned about $1.2 million back to you, while the higher fee option only gave you back $700,000. Some of you might be thinking, this is dumb, why would anyone be paying those fees? Well, it's actually really common. When you go with a financial advisor, they have a fee, and typically it's an asset under management fee, which to me is just absolutely stupid because oftentimes they just do stuff that you can otherwise do yourself, but then they charge you a fee for it. And again, as your portfolio grows larger and larger, that fee doesn't really change all that much. And so what exactly are you paying for? Exactly, cut the fees. Second thing, human error. Folks, we're humans, we're emotional. Green days, we feel good. Red days, we feel bad. However, we cannot allow our emotions to dictate the actions we take in the market. And it's commonly accepted, investors who sell out tend to stay out, meaning market goes belly up, they're like, oh my gosh, we gotta get out. It's much harder psychologically to re-enter the market, and that ends up costing them. Take a look at this example here. $10,000 invested in 2007. But let's say instead of having the money in the market for the entire period, you sold out and you ended up just missing out on the 10 best days in that entire stretch. Well, your returns would be reduced by almost $20,000 had you just let the money stay in the market the entire time. But let's say you ended up missing out on the 40 best days, well, you would have $30,000 less simply by, I sold out, I don't know when to enter, I'm gonna stay out, you missed it. So folks, try to have your philosophy defined and cut out as much emotion and do not have as much of a visceral response to red days or even green days for that matter. The third philosophy is diversification. Folks, do not put all your eggs in one basket. Listen, I get it. We know of a friend of a friend of a friend who's a crypto billionaire. We know a friend of a friend of a friend who's a GME millionaire. But at the end of the day, those are just incredible risks and incredible gambles. For the vast majority of us, we should have a well-diversified portfolio with assets that are not correlated. We want to add as much diversification into our portfolios as possible so that in periods in which one asset class moves one direction, the other might hold steady or move in another. And a quick note, if all this seems confusing, you're just thinking, oh, can I just give this to a financial advisor? Yes and no. Yes, you can give it to a financial advisor. They'll roughly guide you in the right place. But financial advisors, like the traditional model, is going to absolutely kill your returns because of their fees. But as a pro tip, and something that I've been actively searching for and I'm ended up being able to find it, though it took a little bit, is finding flat fee advisors. Basically, these are the advisors that charge a flat fee regardless of how big or small your portfolio is. Full disclaimer, Facet is not a sponsor of this video, but I have partnered with them on Instagram and some of my short form content, but I'm also a member of their services and I absolutely love it. So the biggest thing with Facet is that they look at everything, every facet of your life, including real estate. Traditional financial advisors don't care for that. So if anyone's interested in financial advisor, I highly recommend flat fee model. I personally have used Facet. I still think I have a valid discount code that waives like the initiation fee of $200 to $250. If you want to check it out, that's linked down there as well. But again, any flat fee model will do. The first stock on the list or fund is VTI, also known as the Vanguard Total Stock Market Index Fund. Description: this investment seeks to track the performance of the US Total Market Index, and it measures the investment returns of the overall stock market. The fund employs an indexing investment approach, which represents approximately 100% of the investable US stock market. Basically, you buy this, you have exposure to the entire US market. And right now, that trades for a little bit over $220 a share. Composition: since you're giving exposure to the entire stock market, you're gonna have shares in Apple, in Microsoft, in Alphabet / Google. Pretty much every single company that's either doing well or not so hot, you have exposure into. Now let's look at returns. Over the past 10 years, this has averaged an annualized return of 11.62%. It also pays a dividend quarterly, and the last payment came in at 1.58%. Now let's talk about expenses. Sure, this is gonna cost you something. Actually, no, this is almost a near zero expense ratio, coming at 0.03%. And lastly, balance. For me, this is like 95% of my portfolio, which I will call out a caution where right now I have home country bias. Basically, I'm in the United States, I have heavy exposure to the US. And this is actually true around the world. Folks who are investing in the UK, in France, wherever you are, you're gonna have some sort of home country bias. So it's important to get some broader exposure. However, right now, yes, I will say that's probably the one risk that I have, is that I have huge exposure into the US market. Stock number 2, VXUS, which is also known as the Vanguard Total International Stock Index Fund. A description of this fund: the investment seeks to track the performance of a benchmark index that measures the investment returns of stocks issued by companies located in developing and emerging markets, excluding the United States. In other words, it's exposure to stocks not in the US. And taking a look at this Morningstar box, you've got exposure to small, mid, and large cap, as well as value, growth, and blend. Taking a look at composition, these are companies you likely may have heard of and wondered, hey, how do I get some exposure? Taiwan Semiconductor, Nestle, Novo Nordisk, Samsung, AstraZeneca. And coming in for a little bit over $50 for one share of this ETF, you will now hold exposure to 7,972 stocks around the world. Rate of return: The 10-year return for this ETF has been 4.27%. A quick comment on that, yes, the US market has largely outperformed the broader market over the last 10 years or so, maybe extending to 15 or 20. However, that is not always the case, and that is why earlier we said diversification is still important. Dividend. This fund pays a quarterly dividend, and the last payout came in at 2.89%. Expense ratio. This comes in at 0.07%. And as for balance and exposure for my portfolio, this is probably 3 to 4% of my overall portfolio. And I fully recognize that's really small, and I fully recognize my home country bias. And that's something I certainly need to work on, understanding that the last 50 years of US dominance might not extend for the next 50, and I should probably start thinking about how I'm rebalancing my portfolio moving forward to get that number up from the single digits. Third stock on the list, BND, also known as the Vanguard Total Bond Market Index Fund. Description: this investment seeks to track the performance of the Bloomberg US Aggregate Float Adjusted Index. Index measures the performance of a wide spectrum of public, investment-grade, taxable, fixed income securities in the US, including government, corporate, and international dollar-denominated bonds, as well as mortgage-backed and asset-backed securities, all with maturities of more than 1 year. In other words, bonds. You get exposure to all the bonds. Composition. As you can see, the vast majority of the exposure is going to be to government, corporate, as well as securitized bonds. And currently, BND trades at a little bit over $70, and for that, you will get exposure to over 10,000 bonds. Rate of return. The 10-year return of BND has been 1.72%, which absolutely, let's call a spade a spade. That's abysmal. However, keep in mind, the last 15, 20 years, not so great. The 15, 20 before that, bonds were solid. And as of right now, bonds are actually performing extremely well. For example, a 3 or a 6 month treasury note is yielding over 5%. In my lifetime, I've never seen that. So I just want to remind you that yes, how something has always been does not mean that's how it will always be moving forward. And that's why we need to consider exposure to fixed income securities. Dividend. Pays a quarterly dividend, and the last payout was 2.6%. Expense ratio. This comes in at 0.03%. And as far as balance of my portfolio, bonds account for less than 1%. Listen, at the end of the day, you absolutely want exposure, you want diversification into bonds. However, if you are younger and if you're able to take risk, I wouldn't put as much money into fixed income. Instead, that's something we age into. So as you get older, you're gonna have a larger percent of your portfolio to become fixed income. And as for how much you should have in bonds, people usually use a formula where they take 100 minus their age. That's how much they should have in equity, so the broad stock market, and whatever's left over, they would throw into bonds. So let's say you take 100, you're 20 years old now, you take out 20, you should have 80% in equities and 20% in bonds. Personally, I think that's a little bit conservative. I have a little bit more risk tolerance, so I'm able to dial it up. In addition to that, people have said because we're living longer, the 100 minus age is not valid. Let's take a look at 110 or 120 minus your age. So if it was 120 minus your age, that would be 100%. You're 100% in stocks, 0% in bonds, maybe closer to what I would take a look at. And that would titrate up as you age. Taking a look at this 3-stock portfolio, I've got exposure to the entire US market. I've got exposure to the entire international market, excluding the US. And I've also got exposure to bonds. The only thing I'm really missing here is real estate, but because I have 3 rental properties, I've got exposure there. Now, if you don't actually want to own rental properties, you could look at REITs as well, but I'd say that's a pretty solid and well-rounded portfolio. Now, have I taken some singular bets here and there? Yeah, absolutely. But that's also money that I'm willing to just, gone, light it on fire. And that's pretty much it. I try to check my portfolio very infrequently. I invest dollar cost average month over month, and I let time take care of the rest. The less you look at your portfolio, the more money you make. That's generally what we see, because the less emotional you end up being. Now, here's a bonus. If you're really lazy and you're like, oh my gosh, John, but I've got to balance out how much US, how much international exposure, can I do something even simpler? Yes, you can. There's a ticker called VT, and that is going to give you exposure to literally everything. So VT is also known as the Vanguard Total World Stock Index Fund. And this is basically, you could think of it as a combination of the earlier two, VTI and VXUS, but the split is about 60% US to 40% international. Some people just buy that, plus the bond fund, and then obviously they might have some real estate, and that's it. So the composition of VT, as you can see here, you've got exposure: Apple, Nestle, Microsoft, pretty much every single company in the world largely is shoved in there and you've got some exposure. And for a little bit under $100, you can get exposure to over 9,543 stocks. That's a rate of return. The 10-year return is 8.11%. It also pays a dividend quarterly, and the last payout was 2.06%. Expense ratio, this comes in at 0.07%. Now, me personally, I don't have this because I'm individually managing how much exposure I want to US as well as total world. But if you're really lazy and you're like, can't be bothered, then you can jump on this as well. That's all I got for you, folks. This has been a bit of a long one. I'd love to know, comment down below. Does this make sense? Have you considered it? Are you still picking individual stocks? And if so, how have the returns been over the last 10 years? And how do you think you'll do over the next 50? That said, I'll catch y'all in the next video. Peace.